Now, let's take a look at the world of mergers and acquisitions. After a slew of big deals in the first half of the year, activity, well, it's slowed down as recession fears have picked up. But that doesn't mean that deals have stopped completely. Now, since the third quarter began, we've seen Express Scripts offer to buy Medco, $34 billion, PetroHawk's $15 billion offer for BHP Billiton, and Carl Icahn's offer, he's bidding, what, $12 billion for Clorox. So what are the trends to watch for in M&A as 2011 rolls on? We have Fred Lane. He is the vice chairman of Raymond James. He joins us now in Boston. He's recovering from Hurricane Irene. We also have Iyan Adewuya, Bloomberg senior M&A analyst, joining us here in New York. Good to have you with us, Iyan. Let me start with Fred Lane in Boston. Fred, all right, I know I appreciate you coming in when you got to do all that cleanup, but tell us about what the state of mergers and acquisitions is like right now. Cash, there's a lot of it. Are companies going to spend?
I think they are. You know, when you're in a period like this and there's so much uncertainty and there's so much capital available, both balance sheet cash and also bank debt and senior debt, investment grade debt in particular, it's compelling to be looking at acquisitions. And I have to say that large companies dealing with slow revenue growth in their basic businesses are seeing excellent opportunities to add to the top line with complementary businesses. Let me add to that and say that by historical standards, the S&P 500 is selling at relatively low PEs. We haven't seen price earnings ratios in the S&P 500 this low since about 1982. So you add it on. Now, I'm not talking about absolute level. I'm talking about PE ratio. But nonetheless, that was a period, as you will recall, where interest rates were much, much higher. So I think what we're seeing in these low valuations, of course, is a tremendous amount of uncertainty about economic outlook, monetary policy, and these are concerns that are largely global.
Iyan, this idea that Fred raised having to do with sales growth. If you can't grow your own sales, go out and buy someone else's.
I absolutely agree with what Fred said. As a matter of fact, I'll add a little texture to that. I think what's happening in the market right now, you have a little bit of the haves and the have-nots. And Fred really alluded to a lot of large names that have kind of solid credit ratings, a lot of cash on their balance sheets.
They issued a lot of debt, right?
Yeah.
Because they've got a lot of cash, low cost.
And financing costs are low, and they're able to really go out there and do deals. And so while there is a slowdown in M&A over the last 2 months, we really had a record 3 months preceding that, about over $200 billion worth of deals in April, May, and June. And so when you look at now what's happening in the marketplace, large, solid companies are able to go there and be a little bit more aggressive in terms of their acquisition strategy. Look at what Google is doing. And some of them making defensive plays, while others who are not as solid may have to go back and kind of rethink their strategy. Really tough to do a deal right now and price a deal, particularly when there's a lot of volatility in the market. But if you're a solid name, you're able to go out there and you have really good valuations to pick from.
Fred Lane, I want to bring in that theme of volatility. I mean, how do you put together a bid in a marketplace that could go up 3% in one day?
Well, I think 3%, 5%, 7% is actually not going to be the difference between making a proposal and not making a proposal. You know, these typical premiums running 30 to 40 and even 50%. I think it's important to recognize that what Iyan said was true, that we've had a lot of headline-grabbing deals. Deals over $1 billion, though, are only up in numbers by about 10%. The value of those deals, however, is up about more than 50%. So this has been a period of great headline-grabbing deals. So when there's a slowdown, I think it's natural to say, gee, what happened to the M&A market? But let me say that in deals between $100 million and $1 billion, which is always the meat and potatoes of the market, and certainly the meat and potatoes of Raymond James M&A advisory business, those deals are up 30, 35% with commensurate increases in underlying dollar value. So the business remains very, very strong. And I want to repeat what Iyan said. I like the way he put it. It's a battle of the haves and the have-nots. And it's really Darwinian out there. You know, those who are, it is survival of the fittest. And that's reflected in borrowing rates. You know, I spent a good part of this weekend when I wasn't searching for a cell phone place to plug in my cell phone because my phone service was dead, my electricity was dead, my water was dead. But I spent a good period of time on the phone with a board of directors, and we're looking to make a bid, and we're looking at raising about $400–500 million in the debt markets. And we're looking at pro forma leverage of about 4 times EBITDA. which back in 2005, 2006 would have been pretty modest. But in today's world, the board of directors is saying, and I think appropriately, with the CEO agreeing, that this is a lot of debt to take on. Maybe we ought to structure the deal a little differently. Maybe we need to use a little more stock. And I think it's reflective of the times we're in right now, where the banks might lend, but you're looking at a dismal economic outlook. You don't want to dig yourself into a hole.
All right, we got to leave it there. I want to thank you so much. Fred Lane joining us from Raymond James, wishing you the best on a cleanup, and of course, Iyan Adewuya from Bloomberg M&A Advisory.